Thank you, Sandil, for that detailed introduction. And thanks, Varadarajan and other managing committee members for the invite. Also to the Corporate Laws and Corporate Governance Committee, led by our own Sri Priya. Thanks to her for this invite as well. As far as the topic is concerned, it's a fairly, what should I say, a familiar topic to all. It's not a topic which is something new to be introduced. Probably what we are looking at in this topic is based on experience. What are those important areas which auditors need to take care in their reporting perspective? And since the entire audit function in a sense, particularly audit of companies, which is audit when we say is generally associated with companies. Of course, non-company audits are also important. As far as audits are concerned, the regulatory environment is driven by the Ministry of Corporate Affairs, largely through the Institute of Chartered Accountants of India, of which all of us are proud members. I just want to begin with highlighting to all of you MCA's mission statement, which is visible in this opening slide. And once you actually understand the way they look at things, our reading of the Companies Act and our approach to compliance of the requirements in Companies Act changes substantially. And I have experienced this hands-on, working with them across a 6-year period, where anything and everything the ministry does and the entire thinking process of the ministry is either towards empowering businesses, helping businesses to do well, or it is to protect investors. So everything which you see in the ministry, whether it is an act or a rule or an amendment or whatever comes, they will have one of these two objectives which they will try to achieve: helping businesses or protecting investors. Both of them are core to the ministry's functioning. And towards this, they have set for themselves 4 hats, which they keep wearing interchangeably: being a regulator, facilitator, educator, and importantly, an integrator. When you say integrator, what they try to do is integrate with the entire business ecosystem which is there. So, and what you are seeing in this slide, those 2 lines are not what I have drafted. They are part of the ministry's website, MCA's website itself. And I've consistently seen all the discussions at the ministry. They have always expressed, I've not come across a single meeting where they have had doubts on whether the auditors can deliver. They've always said that we believe auditors can deliver, and we are counting on auditors to help us improve the overall governance in the country, and importantly, highlight red flags as early as possible. So give us red flags as early as possible so that we can take corrective actions before it goes out of control. So that's been the key message from the ministry always. Whatever I speak of, the little 1 hour plus, all of these are my personal professional views. None of them should be seen as views of the institute of which I was actively engaged. I will broadly share my thoughts in 5 sections. I'll do a little bit of context setting, so little low because everybody is aware, but I'll still like to walk through a little bit of context setting. Spend substantial amount of time on audit reporting and key safeguards, what you see as arrow upwards. And I'll spend little time on ethics and Schedule 3, both of which are relatively, I shouldn't say relatively recent. Code of Ethics revised came into implementation from July 2020, and Schedule 3 revised has come now. For Schedule 3, I have one single slide on points which you need to take care, essentially again, safeguards. And on ethics, again, couple of slides, basically again, from the perspective of safeguards with reference to performing the role of an audit. The two opening key messages I'd like to give, and this is a message of our founder president, late Shri GP Kapadia. I will just focus on one part of the quote, which is the paragraph at the top, where it goes on to say that every learned profession should develop a sense of social purpose and social obligation, and this should be more so in the case of accounting profession. So when it talks about social purpose, social obligation, it is not with reference to doing some so charitable activities, providing drinking water, providing financial aid. It is not that. In fact, it goes on to say that the financial statements of which we all play an active role, either as a preparer or as an auditor. There's so many stakeholders who depend on that, and those stakeholders constitute the society, whether it is a large pool of investors or the bankers, again, who deal with huge tons of public money. And we can't think of businesses where there is no banking dependency. And lastly, regulators, including taxation authorities, etc., all of which essentially constitute society. So whatever work we perform as auditors, it's extremely important to understand that we are delivering a social purpose. So it's not client objective. I just want to highlight for all of you a great debate which I have seen over a period of time. As an auditor, what comes important? Client interest or public interest? In my mind, I'm extremely clear. Any task which is done because of a regulatory requirement, what is important is only public interest. If audit is mandated by law and we perform the audit because of a legal requirement, no matter who appoints us, no matter who pays the fee, only public interest matters. And that's true for every audit we do. In the case of engagements where it is not mandated by law, for example, company A appoints you to do due diligence for acquiring company B. That is an engagement where it is not a legal requirement. You're doing it on behalf of a client. Those cases, client interest is uppermost. So any professional mandate arising out of a legal requirement, only public interest matters, irrespective of who is appointing and who is paying the fee. The second point which I'd like to mention, and many of you would have heard me on this, but I'll take 30 seconds to speak on the third element. These have been like my 3 golden rules always. The last element, that financial statements, balance sheet, income statement, notes to accounts, cash flow, whatever, and audit opinion, both of them are a communication. They are a communication. Just like each one of us, whether it is our personal life or professional life, any communication we receive, we want that communication to be complete and truthful. So if somebody in family is telling us something, or somebody in office is telling us something, We all individually have this expectation that the communication should have been complete and it should be truthful. So what is true for our expectation holds good for the communication we do through financial statements also, either as a preparer or in the audit opinion. They have to necessarily be complete and truthful. A few slides in terms of context setting, and there's so much of discussion around audit quality. And when we talk about safeguards, it's about ensuring that we have a minimum audit quality. We have crossed the threshold of an acceptable audit quality. Audit quality is extremely important because it is the quality which brings confidence for users in the financial statements. I want to share with all of you one important thing which I have come across over time. Whether it is accounting standards or auditing standards, many have this impression that these are standards which are meant for preparer of financial statements or for auditor of financial statements. But that is not true. The parent document, which is the framework for accounting standards and framework for audit standards, both the frameworks very clearly provide that the standards are drafted keeping in mind the user's interest. Preparer interest is not important. The auditor's interest or difficulty is not important. What matters is only the user's interest. So users as a community are the ones whose interests we have to take care of, and the audit quality is meant to ensure that they have the confidence in the financial statements. Lot of attempts have been made and continue to be made on whether we can define audit quality, but thus far we haven't been able to come to that situation, not just in India, globally. It's a very complex subject involving lots of judgment, estimates, and opinion formation. The beauty of whether it is applying accounting standards or auditing standards is you make these standards to give you guidance on making estimates, guidance on making judgments, and guidance on forming an opinion. So consequently, it's very difficult to arrive at an objective model of defining audit quality. Of course, people continue to put their heart and soul to find a solution for that. And audit quality, as all of us can see, and I heard P.R. Ramesh also talk about it so passionately, there is a need for improving it at the audit engagement level, that is the client level, auditor, auditee client level, at a firm's level, and at a national level itself, we need to work on audit quality. This is a very simple slide from the International Audit Assurance Standard Board, IAASB of IFAC, where they talk about audit quality. The three important elements. One is to create awareness of what are the important aspects of audit quality. Second is to keep encouraging stakeholders to keep conversing, to keep exchanging notes on how to improve audit quality. And lastly, increase dialogue or facilitate dialogue between stakeholders on audit quality. So IAASB's approach on audit quality is largely around creating awareness on the key elements which will go towards audit quality and creating an ecosystem of people conversing around audit quality. This is again an important, nice slide from International Audit Standards Board on audit quality, where they talk about the elements which go towards audit quality. Recall the previous slide that talked about elements. One is compliance with law, basically performing work, the audit work in accordance with whatever professional standards which are there and the regulatory environment. So that is one key element. Are you doing work according to those standards and the framework of law? The second element is compliance with the firm's quality control procedures. Every firm needs to have a quality control procedures, and are you following the same? This is SQC1, and I'll spend a little time on SQC1 a little later. And then appropriate reporting, or before appropriate reporting, ethical team behavior. So typically audit is team engagement. And what is important is when the audit is being done, the ability of audit team to raise their concerns without any fear of being reprimanded is important. There can be instances, and I'm sure some of you have come across, there can be instances where you don't give the audit team, whether it is the audit managers or the article students, the freedom to raise their concerns, and we tend to reprimand them because we are many times sensitive about the client engagement. So the ability to have an ethical team behavior, that's basically have an environment where there is no fear, is very important. And last element is issuing audit reports which are appropriate in the circumstance, unmodified or modified. If it is a modified report, whether it is a qualified or whether it is adverse, disclaimer, whatever is the appropriate report, and beyond that, applying SA 706 and 701. So these are four key elements of audit quality as identified by the International Audit Standard Board. There are few slides. I will quickly rush through them. I'll not read them in detail, but I'll leave a copy of the deck behind and you can go through at leisure. This is just to tell you the scope which all of us have and the responsibility which all of us have as a profession for improving audit quality and thereby confidence of the stakeholders in the audit fraternity, Just like everything else in life, we are as strong as the weakest link in the chain. So it is a collective responsibility to ensure that the weakest link is fairly strong, because if something can break, it can break only there. And that is what determines the society's confidence in the auditors fraternity. Quality Review Board is an independent board within the institute, which has about 11 members, 5 from the institute and 6 who are government nominees. This board was set up after the Companies Act amendment in 2000, after the CA Act amendment in 2006. The board took some time to get constituted, and since 2012 to 2020, of all the reports which have been reviewed, and it's a fairly detailed review, the experience is that 60% of the cases, significant improvement is required. And please note, we are a profession of more than 50 years old by that time. We were a profession of more than 60 years old by the time this review started. And the review showed that 60% of the cases, improvements were required. Significant improvements. Another 6% improvements required, and only 34% generally acceptable. So look at the impression an external stakeholder gets about the profession, that only 34% of the audit engagements were generally acceptable. And mind you, for a profession which is more than 60 years old by that time. This is for a specific year of 2019-20. And this year's statistics were little more disturbing. 19-20, 85%, 82 plus 3, 85% of cases improvements were required, and only 15% of cases were generally acceptable. Generally acceptable. And mind you, 19-20, we were a 70-year-old profession in India, 70. And this is what came out of the reviews done, pretty large audits. So basically pick up large audits and then do the engagements. And these are all reviews done by chartered accountants with experience of over 20 years and more so specific industry experience. And these are observations around non-compliance with specific audit standards, accounting standards. And we have something similar in the context of FRRB, Financial Reporting Review Board. A difference between the slides which you saw earlier and this is, in a quality review, the reviewer comes to the auditor's office, spends exactly 1 week, and goes to the audit working papers and forms an opinion on the quality of work done. Whereas in FRRB, that is called as a hot review. FRRB, we do what is called as a cold review, wherein the financial statements are taken from public domain, MCA website and all, and through a three-tier review process, you do a review as to whether the financial statements are in compliance with the Schedule 3 and accounting standards requirement, and whether the audit reporting is as per the requirements of the audit standards. So this board also was constituted after the CA Act was amended in 2006. And after this board does a review, if there are material non-compliances, it goes to disciplinary action. Otherwise, this board's main focus is to communicate to the audit firm that, look, these are some observations we have come across from a review of the annual report. Maybe you will have your own reasons, but there is a scope for improvement. So an advisory is issued. So over a period of time, since it has been formed, almost about 11 years, 12 years of journey, close to about 800 plus and reports have been done for 956 reports. 160 have been referred to disciplinary committee. 160. So 16% reported to disciplinary committee for action. 154 have gone to the regulators like SEBI, MCA, IRDI for taking needful action. 35 of them have gone to Election Commission of India because they were relating to the annual accounts of the political parties, and remaining were advisories which have been issued. So experience of FRRB in terms of non-compliances across accounting standards and auditing standards, accounting standards and Ind AS as well. Now let me come to the first of the two core sections on which I wanted to spend time. First and foremost on audit reporting. On audit reporting, particularly from a key safeguards point of view, most important is the code of ethics. In fact, as far as code of ethics is concerned, in my own experience, many have an impression that we know what to do, what not to do, and consequently, we tend to go on the basis of our own personal judgment of what is ethics. But code of ethics is a fairly large document, and this document was revised in 2020, effective July 20, and this particular document is now same as the International Code of Ethics, and Code of Ethics as a document has gone through about 11 versions in the past, and what you now have is the 12th version. And this particular current version, we have 3 volumes which are there. One is the rules, which are the same as international rules. Second is the institute pronouncements over time. And third is the past judgments on applying Code of Ethics. I'd strongly encourage, particularly firms who are active in audit as an area of practice, that if there is one document which has to be sort of taken full control of for doing a right audit and to have the right safeguard, it is this document on Code of Ethics. Second is compliance with the reporting requirements under Section 143 in the case of companies. And needless to mention, compliance with accounting standards. On accounting standards, I want to make an observation that if you look at the SA 700 reporting, what is 700 reporting all about? The reporting says that financial statements have been prepared in accordance with the accounting standards framework as applicable. So for you to form an opinion that financial statements are in accordance with accounting standards, it's important to ensure that financial statements are prepared completely in compliance with the requirements of the various accounting standards. And then we have the revised Schedule 3, which is there now, fairly substantial amendments. I'll spend a little time later. Internal control on financial reporting. While it is mandatory for certain companies, I'd like to mention that this is mandatory for all audits. We have this SA 315, SA 315. Among all the audit standards, my own personal experience as an auditor, SA 315 is at the core of audit. SA 315, it is the heart of audit. And when you commence your audit and you do your planning and then start performing, everything starts with the standard called 315. And in 315, it is all about understanding the auditees, the entities, internal control environment, whether its design is effective and whether its implementation is effective. So whether a separate IFC certification is required or not, fundamental to every audit is the existence of internal financial controls. So every audit you do, even if ICOFR, internal financial control reporting, is not separately done because you are exempt, it is important that your audit working papers, the approach to audit, should start with evaluation of the internal financial controls which are existing, understand their design, the effectiveness of design, understand their implementation and how effective it is. Then performing work as per the audit standards is a next important task. Almost 46 audit standards. Of course, what will be relevant for a normal audit is about 25 standards or so. And then reporting under SA 700 and if required SA 705. SA 700 I'll spend some time. CARO 2020, which has now come about. On CARO, one word of caution I would like to mention. Unlike the earlier CAROs, which was more like a checkbox, yes, no, more like a checkbox, or you could go through general wording. I think Ramesh was talking about generally and all that stuff. In the new Caro, all of that is not possible. The answers need to be fairly specific, and the ministry has substantial expectations on this particular report, which will be part of the auditor's report. And as far as the Caro is concerned, unlike in the past, ministry has developed a tool for analyzing all the Caros which are filed, and auto notices would be sent based on observations which are there in Caro. And then you have the rotation of auditors and joint auditors. Rotation of auditors has been there since the new Companies Act came in, and joint auditors, there's a lot of discussion happening. I want you to be cognizant of one particular risk here, and I've seen this when the previous rotation happened. And for many of the audit firms, the rotations will be happening now. Now they should be happening. Those who are existing auditors at that time, some of those rotations would have now started. On rotation, very important to understand is that the new audit firms are unlikely to accept the positions taken by the earlier audit firms, and the consequent friction and the kind of reporting and opening up subjects for this will arise. Opening up subjects for debate will arise. So that is one important aspect we need to keep in mind, that rotation of auditors will have a substantial impact on quality. Unless the work is of high quality, when the new auditor comes in, the kind of stress or tension it creates is something one has to experience to know what it is. And with joint auditors, again, of course, some of us are familiar with the concept of joint auditors, which we do in the context of banks and others. And now there is generally a environment in India to encourage more of joint audits. As far as joint audits are concerned, two things we need to keep in mind. One is a situation where each auditor points finger at the other without realizing that the remaining four fingers would point towards them. So that is one part. Second is, even in the case of joint auditors where you have segregation of work, the standard has a very clear, the SA 299 has a very clear position that when it comes to the overall reporting, there are subject matters on which all the auditors need to concur. And there is a provision also for issuing separate audit reports if one auditor does not concur with that of others. So joint auditors is different business altogether. It's not easy to navigate the risk associated with a joint audit. So please don't take joint audits to be pretty light. As I said earlier, you're only as strong as the weakest link in the chain. And if there are three joint auditors and one of them is weak, and when an inquiry commences, all the three firms will get locked. All the three firms will be put on notice. And it can be pretty painful. So joint audits are to be done very carefully. And there are countless legislations all of us are familiar with. I'll spend a few minutes on this standard SA 700, the way reporting needs to be done. It might be a little basic for many, but I want to still go through for the reason that I've come across audit reports which have been signed more as a template without a complete understanding of the amount of responsibilities which actually the auditor carries. In SA 700, the responsibilities include, first and foremost, do the financial statements have adequate disclosure of all the significant accounting policies? So as a signing partner, I have to ensure that all the significant accounting policies are there. countless annual reports, and I can't mention the number. You will find annual reports where accounting policies on many subjects are not there, not there. Copy paste from an earlier period or from another entity. And many of the matters, the accounting policies have not been disclosed. So first responsibility is to ensure that there's an adequate disclosure of significant accounting policies. Second is consistency and appropriateness of accounting policies with the financial reporting framework. So we have at present we have, from a Companies Act point of view, two financial reporting frameworks. One is the Accounting Standards Framework, other is the Ind AS framework. So we need to, when you give an opinion, your SA 700 report talks about the consistency and appropriateness of accounting policies with the financial reporting framework. So whatever policy you have selected, is it consistent with the reporting framework? Is it appropriate policy considering the reporting framework? So that's the second assessment. So when you give an audit opinion, you are commenting on the second element. I'll give you a small example on this. Of course, in practice, it is quite difficult, but I think somewhere we have to get there. If you take inventory valuation, for example, when you do the estimation of cost, you have first in, first out, you have weighted average, and in some situations, specific identification method, etc. Now, as far as the policy which you select, it is very important that in some industries, the accounting policy shall be only specific identification method. You will not have a choice of following first in, first out or weighted average. For example, you buy inventory dedicated for certain projects which are cost plus projects. So those kind of inventory, you are going to specifically identify and value that particular inventory. You can't say, I have material which I bought for 10 different projects, all of this material, I will follow a first in, first out or weighted average. So if there's a cost plus invoicing model in some of the projects which are there, and you bought the material for a particular project, those have to necessarily go through specific identification method. Similarly, you will also have a situation where there's an inflationary environment and an environment where prices are fluctuating. In an environment where there is inflation, the better approach for arriving at cost is first in, first out. And where there's a fluctuation, it is the weighted average method. So accounting policies, choosing them and ensuring they are consistent with the financial reporting framework is important. Third is the reasonableness of accounting estimates. Financial statements are full of accounting estimates, and these accounting estimates, whether it is with reference to depreciation, life of the asset estimate, or with reference to investments, fair value estimate, current investments, lower of cost and fair value, or inventory NRV, or receivables, provision for bad debts, impairment, actuarial valuation, all of those, the reasonableness of accounting estimates is very important. And on this, I want to spend a minute with a specific example like AS 15. If you take accounting standard like employee benefits, AS 15, generally the approach is get an actuarial report, take that number and put it inside the financial statements. So whatever the actuary text, you take it. But that will not reduce your responsibility. The auditors responsibility is whether the way the actuary has arrived at, is it a reasonable accounting estimate? So when an actuary is arriving at, he is considering number of employees, he is considering their salary structure, he is considering the average age of the employees, the attrition rate, the investment return rate, the discount rate, all of these assumptions are there. 50 basis points difference in your investment return rate or 50 basis points difference in your discounting rate can change your estimation of your gratuity liability. So as an auditor, I need to see whether all the estimates which have been done, all the assumptions which have gone into the estimate, are they reasonable? Is the discount rate reasonable? Is the salary growth rate reasonable? Is the attrition rate reasonable? And I need to back it up with enough working papers to justify the reasonableness. That responsibility sits inside SA 700. One single standard, template report. SA 700, we treat it as template report. But in the same standard, it talks about auditor confirming reasonableness of accounting estimates. The fourth element is relevance, reliability, comparability, and understandability of information in the financial statements. So it is the auditor's responsibility to ensure that all of the information which is given is relevant, can be relied upon, comparable with that of the previous period, and somebody is in a position to understand it. So you should not present it in a way a user will find it difficult to understand. That responsibility is also with the auditor. Only if you cross this, you can move towards an unmodified opinion. The next assertion we give is whether the disclosures are adequate to enable users to understand the effect of material transactions or events on the information in financial statements. So again, the auditor needs to see there could be material transactions like merger has happened, demerger has happened, or some curtailment of business has happened, or there's an impact of a long employee strike. So whether the impact of all of these, has there adequate disclosure? That's again a responsibility of the auditor. Terminology used in financial statements is appropriate. And are we referring to the right financial reporting framework? So am I referring to Companies Accounting Standard Rules 2020 or Companies Accounting Ind AS Rules 2015? So one small precaution, as many of you must be aware, for the accounting standards, earlier it was the Companies Accounting Standard Rules 2006, but in June 2021, what was issued under the erstwhile Companies Act and carried through transition provisions have been separately notified now under the new Companies Act. So when you do financial statements for the financial year 22-23 onwards, you should refer it to the Companies Accounting Standard Rules 2021. Then qualitative aspects of accounting practices and possible bias in management judgment. So as an auditor, before you give your opinion, you should identify what are all the areas where there is a management bias which is possible, whether it is revenue amount or whether it is estimation of some cost or provision. So all of those cases, the qualitative aspects needs to be taken into account. And then the materiality of uncorrected misstatements individually or aggregate should be considered before you can conclude on your opinion. On this materiality of uncorrected misstatements, I just want to highlight a practice which I've come across in some firms. Normally, when we do our bank branch audits and all, we issue memos, audit memos or whatever corrections are done. Sorry, I didn't realize that my video was off. Sorry. So materiality of all the, we usually give memos of correction. I have come across some audit firms, when they go to the audit committee, they actually give a list of all the audit memos they have issued, But my own view, it is a very highly matured state of audit. The few companies I've come across. And my recommendation would be, while you may not necessarily carry it up to the audit committee because there's no mandatory requirement of it, at least internally as part of working papers, it's important to keep a memo, a list of all the audit adjustments which have been carried out, what you have pointed out, because tomorrow, when somebody is judging audit quality, whether through a review or any other situation, you will have evidence of all the work which has been done. Why this is important also is because if there are lots and lots of memos and they're repeatedly happening, it probably speaks about the quality of the internal financial controls also. So consequently, before you conclude on your opinion, in case there are uncorrected misstatements, in practice, most of them get corrected. So if there are uncorrected misstatements, we need to see individually or in aggregate what is the kind of impact which is there. And for all of this work which is done, do we have sufficient appropriate audit evidence? And then come to a conclusion on reasonable assurance. And if we are convinced on reasonable assurance, you go ahead and issue an audit opinion. So what we typically sign off as a simple 1.5 page audit report, has so much of responsibility sitting. The 700 standard, that one standard, there's so much responsibility sitting here before you can issue that particular audit opinion. Now, let me spend a few minutes on ethics. As I said at the start, there are two sections on which I don't intend to spend much time. One of them is on this section on ethics. I'll use this only for highlighting a couple of points, more specifically for newer members who are in practice. My own experience on ethics is it is directly proportionate to the competence and skill of the auditor. Generally, when you are pretty strong in your subject in terms of the knowledge you carry about the whole arena of audit, accounting standards, audit standards, company law, all of it put together, code of ethics, when you are generally complete on those cases, your ability to tell the client and the client listening to you is pretty high. The moment we have vulnerability, ethics tends to get compromised. So ethics, particularly as a practitioner, is directly proportionate to competence and skill. And as I mentioned at the start, there's a huge expectation from society at large that the work of the auditors can be relied upon for the decision making. All that we need to ask ourselves is, just like when we expect that we can place confidence or trust in a medical report, same thing with the users of financial statements, they want to place a similar kind of a trust. Are we able to provide that same kind of trust? And when this new code of ethics was drafted by the Institute and issued effective July 2020, it was formed on the pillars that the code of ethics cannot be a static document. It has to be dynamic, vibrant, change with the times. As I told you earlier, this is the 12th version of the code of ethics which we have. And it does have a direct effect on the quality of audit and other services. And unlike accounting standards, audit standards, ethics, the way they are drafted, is at a conversational level. If you read the code of ethics, they will not look like a legal language and all. They will all look like uh, as if you're speaking to the other person. So that's how they're drafted. And key for ethics is a high level of transparency. Ethics and transparency go hand in hand, the two sides of the same coin. Couple of important points is when it comes to ethics, sometimes people have a tendency of doing hair splitting. For example, when you talk about rotation of audits, you need to get the NOC. You need to get the NOC from the other auditor. While that is a statutory requirement, a good ethical practice would be to get a similar NOC even for an internal audit, even for other professional works which are done. So as far as the code of ethics is concerned, it basically gives you guiding principles when it looks like mandatory for statutory audit and all. The similar principles should apply for other types of work as well. And when the institute enforces the disciplinary mechanism, that mechanism largely is on whether you have conducted yourself as per the code of ethics. One of the key elements there is about other misconduct. And on other misconduct, please note, it is very, very wide powers with the institute. And when institute applies this other misconduct, it is not just allowed whether audit standard is applied properly, accounting standard has been applied properly. They go to the extent of behavioral aspects, whether you have used any inappropriate language. For example, there are cases where the auditors tend to write a foul language in the communication which are done with clients when the relationship breaks. There are cases which are there. That is also treated as a misconduct. So while you may have complied with the audit standard, complied with accounting standards, the behavioral aspects also come into account when it comes to implementing the code of ethics. From a safeguards perspective, these are 5 threats which all of us are familiar as auditors. And every audit engagement we do, and each year, even though it is my existing client for last 4 years, now when I need to do a review and keep it in my working paper as to whether there is a self-interest threat, a self-review threat, advocacy threat, familiarity threat, and intimidation threat. I'll just spend a minute on the third one alone, advocacy threat. And this actually comes as an experience over a period of time. Many times what happens is, during the course of audit or otherwise, we tend to take a position. We at times take such a strong position that it becomes difficult for us to come back, because all of a sudden we are human beings and there is that certain element of ego. So when you do a professional work, it's very important to ensure that you don't get so much individually attached to a point, to a particular opinion, a particular view, that it becomes difficult for you to retrace from it later, which will actually impair your objectivity and independence of doing the work. And I have seen this both when I was an auditor and as an auditee. I come across this situation very often. The remaining 4 threats, I'm sure all of you are familiar, but on the advocacy threat, I've come across many cases where, as an auditor, you start taking a particular interpretation, a particular view, and you go to such an extent that withdrawing becomes very, very difficult. I think it's very important that while doing an audit, you should never get to that position where you may not be able to withdraw from that point, when you later come to know that probably that was not the right point. I think that's a very important element of a threat. Essential elements of ethics, all of these are laid down in SQC1, and I'll spend some time on SQC1 a little later. Now, these two slides are the key slides, key safeguards for auditors. And these two slides, which you'll see now, there are multiple points. I don't think I'll be able to sit on explanation on all of these points, but I'm sure these headers are very familiar for you. And when you try to use this in the performance of work, and particularly when you give this to your audit team members, I'm sure you would have covered substantial part of the audit work to ensure that the work has been done effectively. First and foremost is SQC1. And for audit, SQC1, which is applicable to audit firm, is the most important one. And again, here in my experience, I've come across many cases where people have impression that SQC1 is applicable only for listed company audits, large audits and all, which is not true. SQC1 is applicable for every audit. It's applicable for every audit firm. That is the core of an audit firm. And it is important that at partner level, there should be an identified partner who will be responsible for ensuring SQC1 is implemented in the firm and it is being practiced by all the persons concerned in the firm. So it is the standard of quality control, standard or quality control within the firm, right from accepting an engagement, evaluating independence of the firm and the partners for the engagement, identifying the team and putting the team members together, a review process of the work done by the audit team, so on and so forth. This excellent literature within that SQC1, and if SQC1 is implemented correctly, my own personal view, it is highly unlikely that an audit can go wrong. Highly unlikely or can go wrong. There can be large firms who say they are complying with SQC1, but there can be some element where they would have missed out. SQC1, one of the fundamental things is independence. So if that independence has been sacrificed, the firm can have the best SQC1, but the whole thing falls flat. So when I say that SQC1, if implemented properly, unlikely audit will fail. And if you have so many audit failures, it's because they had SQC1, but some element has been compromised. Classic element of that is an element like independence. The next is on appointments, eligibility of the firm, and the process followed by the auditee in appointing the auditors. There are many cases where out of anxiety of professional work or otherwise, we tend to accept work, but at the auditee's end, in the right kind of process has not been followed. We have come across several cases like that. So it's important that at the acceptance stage, our own eligibility and the process followed by the auditee, we have taken control of, and to have a formal engagement letter. Then the audit planning, determination of audit team competence. So it's important that we fill up the team with people who have adequate competence to do the audit. And if you look at SQC1, it gives you guidance on how to satisfy yourself on the competence of the team members. I'll give you a small example. Audit of non-banking finance companies. It's a fairly specialized audit. So it cannot be done by everyone without experience. There are tons of RBI circulars and literature. So those cases, it's important to have as a team member. He could be an employee or a retainer who has exposure on NBFC audit and who can guide you through the process before you get the experience for doing it subsequently. Understanding of the IT environment which is there in the client, some places basic, some places it is advanced, and understanding how the controls behave in that audit organization. Internal audit effectiveness. So from a key safeguard point of view, clients who are investing adequately in internal audit, and if the internal audit is effective, your audit risk reduces. Audit risk reduces. I'm a huge fan of internal audit, not as a checkbox. And when internal audits are done, it does not mean that there should be observations in every internal audit report. The fact that there is an internal audit which is working effectively is reflected by the fact that you have less number of observations. So if internal audit is more often like the safety equipment, they're more like your brakes in a vehicle. So as long as your brakes quality is good, the risk framework is good, control framework is good, it's unlikely that something will go wrong. So it's very important to encourage the entrepreneurs in the case of small, medium enterprises and the management in the case of large organizations to ensure that they are investing adequately in internal audit. It is for their own interest. And then another set of safeguards is in terms of obtaining knowledge of the business, the competitive landscape of the industry in which the client is working, how this client is competing with the other competitors, what is the nature of competition, healthy, unhealthy. All of these have an impact on the audit risk. So good knowledge of business, compliance with laws and regulations, the culture of the organization, getting a management representation letter as part of the audit conclusion, and I'll spend some time on that, and adequate audit working papers. I'll spend time on the MRL alone. On management representation letter, maybe some of you would have heard me on this earlier. Management representation letter, if it is collected from management and put as part of your working papers, it is no protection for you. It is no protection for you. Management representation letter will add value to audit and give protection to you only if A, as an auditor, you have validated all the contents of the management representation letter. So there should be evidence of the fact that the management represented on 15 matters. All the 15 matters, I have verified it. I have verified what the management is saying. That evidence should be there. Second B, there should be evidence of the fact that you considered the contents of the management representation letter in forming your opinion. Only if these two things are there, management representation letter will become a safeguard. It will protect you. So a simple management representation letter collected without doing A and B is not a safeguard, The next set of safeguards, communication with the management, communication with those charged with governance. I've seen largely in the case of smaller audits, 50 crore turnover, 100 crore, 300 crore turnover and all. We don't have the habit of formally communicating with management or those charged with governance. We don't do it because You are interacting pretty regularly. The audit queries are mostly responded by management themselves or the owner of the business himself or herself is interacting with you. So most often we don't maintain a record of communication with management and a record of communication with those charged with governance. Please note, as part of the audit opinion formation, SA 700, those communications are extremely important documents. And later, if you have to get a safeguard, you have to get a protection, you should be able to demonstrate that these are being communicated. And if these have not been done, then the question of protection does not arise. And my experience, both in practice and at the institute last 6 years, has been that, and I'm sure all of you have this experience, when businesses grow, friends have come together, families have come together, brothers have come together, the businesses grow. They become 200 crores, 300 crores, 500 crores, 700 crores. They all grow, things look pretty good, relationships look very good, and your audit risk is considered to be relatively low. More often than not, at some point in time, 10 years later, 15 years later, as time passes by, particularly when it comes to succession planning and things like that, differences start coming up. And at that time, the finger pointing between the groups of shareholders starts. And for these groups of shareholders, their first astra is to rope in the auditor and to tell that the financial statements are not proper. They are not reliable. The finance statements are not reliable. So those cases, the auditor who has done his work very sincerely over a period of time and who has basically considered audit risk as low and probably not paid much attention to maintaining communication with management on audit observations or with the board members or audit committee in some cases, they would tend to get exposed. So it's very important that for every audit, while the businesses are small itself, when the business is small itself, you train the entrepreneurs, that this is a mandatory requirement from us as a professional. So here is this document, and here is this document for the board members, and for you to take it on record and make needful improvements. So that's an important one. Then the other safeguards which you have to take care of is segregation of management and shareholding. There are cases where the principal shareholders and management are same. There are cases where they are different. The risks are different in both scenarios. You cannot say this is safe, that is safe. Where the shareholders themselves are in charge of management, my individual experience, the controls are far more stronger. But that is my experience. And where there is a segregation, where management is set of professionals and shareholders are different, because the interests are quite different. The audit risks are relatively high. Generally, people might think that professional management and shareholders are different, risk is less. But I don't come to that view. My experience is quite different. My experience is these cases, the risk is little more higher compared to a case where the principal shareholders themselves are involved in day-to-day running of the business. Then when you take safeguards, you also need to look at the related party transaction, which all of us are aware about the kind of risks which we can post to an audit, and the related parties who are staff members. Staff members. So more often than not, there are cousins, nephews, niece, all of them working in the firms, in the auditing organizations, and they all become power centers in organizations, and the risk of violating the rules of or the internal controls or the principles of segregation of duties becomes pretty high. So those cases, how do you increase your audit procedures and satisfy yourself is pretty important. Then effectiveness of internal or independent directors, governance across meetings. Is it paper meetings which are happening or in-person meetings happening? Are people actually spending time in the meetings? Are they listening to the presentations fully? Like you can go to an audit committee. There will be audit committees who listen to all the 15 slides you have. There will be audit committees where people will just like to, okay, tell me 2 important points and close. So there are different kinds of meeting governance practices which are there. So you need to assess your audit risk accordingly and then form a decision. So while there would be independent directors and all in many companies, there would be the principal shareholder who will have a certain set of objects and who will have a bigger say on the behavioral aspects of the independent directors and various committee members. So that judgment is pretty important. What is the approach of the organization in terms of financial planning, process, and review? I'll give you a small example. Many companies, I'm talking about audits of 200 crore, 300 crore, 500 crore kind of companies. Of course, larger companies also it's applicable. So what is the planning process they have? Setting up a expansion capacity of 10 crores. So what is the planning process they have for setting up that capacity and how that review is done? So the depth of the process in planning and the quality of reviews which are done will also decide your audit risk. So if the planning process is inadequate or the reviews are inadequate, the audit risk goes up. And the culture of communication to investors and banks. So how do they handle all their investor agreements and banking agreements? Like if you look at banking agreements, before you do any capacity increase, you have to take the permission of the banks. Before you do this, before you do that, you have to keep the bankers informed. So what is the approach followed by the auditing concern? Then other safeguards you have to take care, keeping in mind the shareholders' profile. So the shareholders, to what extent they are involved in the business? Is it a highly relevant business for them or a smaller business for them? And their understanding of their business, or is it a private equity driven business? All of these are pretty important. The shareholders profile, because the kind of safeguards you have to take when you're auditing an enterprise which has a shareholders profile comprising private equity investor is different from one where there are no private equity investors. So that will also decide what kind of safeguards you need to take. And the shareholders funds which have come in, have those shares been pledged or has the capital come from borrowed funds? That is also an element of audit risk. So if somebody is putting high risk capital, equity from borrowed fund, then the behavioral aspects are likely to be different from somebody putting their own capital at risk. So that should also go towards deciding the kind of safeguards you need to develop. Organization culture in terms of timeliness of their tax filings, the accuracy of tax filings, the tax positions they take, aging of the disputes. So there are organizations which have taken very aggressive tax positions. So your risks are pretty high. So that will also be an important safeguard you have to take care. And interest of time, some of these elements I'll go through quickly, but I give you a sense of how these safeguards need to be read, how these safeguards need to be read. The litigations culture of the organization. Is it a litigant organization which files a case here and there? Or is it an organization which is vulnerable for others to put litigations or draw the company into litigations? That also determines the audit risk. The reconciliation of revenue numbers in income statement with what is filed in GST, and some of the income numbers like interest income with the 26 AS returns which are there. So incentive model for the sales team and business team for achieving the targets. The quality of employee appraisal process, the attrition which is happening, all of this you need to be sensitive towards in terms of your audit planning, because these factors will decide whether your audit risks are high or low. So those things need to be taken into account. Similarly, in this slide, I have a list of areas where a similar assessment needs to be done. Interest of time, I'll spend time on a few things like segregation of duties. Is there a maker-checker concept or is it compromised? Second is on FEMA. Wherever you have raised money from an overseas investor, whether it is a friend or a family member, end use of the same and reporting of end use, whether it is in compliance with the FEMA norms, is an important reporting requirement. And there are many cases where some of the companies become shell companies because business has slowed down. You may actually end up with a situation where 50% of your assets are financial assets and 50% of your income is financial income. Those cases, you would attract the requirements of NBFC registration. So those are things you need to be conscious about. And if you have a subsidiary or associate, are you preparing consolidated financial statements? That's a safeguard. There are many cases I've come across where people have subsidiaries, forgot consolidation, associates, forgot consolidation. And while doing ratio analysis, analytical procedures, most often we tend to focus on financial ratios. I would strongly encourage doing audits on non-financial ratios. Non-financial ratios tend to give you much more insights on the quality of information than the financial ratios alone. And then a last point which I'd like to mention before I go to the next section is relying on the work of experts. I sort of mentioned this in the context of actuarial valuation. There are many cases in the audit where you have to rely on the work of an external valuer or some subject matter expert. Or litigations, impact of litigations, impact of tax positions. You take a legal opinion, tax position. When you take those kind of opinions, you cannot say that I relied on an opinion piece of paper or a note which came from somebody. The audit standard requires you to satisfy yourself whether the person giving opinion has adequate subject matter expertise. Similarly, does the person who is giving the opinion, has he considered all the facts in the opinion which he has given? So just getting an expert opinion and saying that I did the tax calculation, what he gave, that is not going to help you. That's not going to help you. So even though there is an expert opinion, the standard places responsibility on us to ensure we have done the due process in terms of the expert's expertise, as well as the information which that person has considered. And last slide on schedule 3. For this year, please ensure the audit team is trained adequately to ensure all the Schedule 3 amendments are taken care. Recall the first slide I told you. Ministry of Corporate Affairs is counting on the accounting fraternity for raising red flags, early red flags. So if you look at all the amendments which are done, and these amendments are what you report in your CARO 2020 also is, one bucket of amendments are for increasing disclosure on governance aspects, promoter shareholding, etc., etc. Another set of disclosures are around the financial discipline or solvency of the organization and going concern aspect. The third category of amendments are towards money laundering. So signals around money laundering. And last is some minor edits, qualitative aspects of some gaps in the past. So broadly, Schedule 3 disclosures come under these four things. So please have an appreciation of what is the background under which these amendments are being done, background in which they are being done. And in that context, try to look at this reporting to be done, both in Schedule 3 and CARO 2020. So with this, let me conclude. I know I've overshot by a few minutes. Apologies for that. I'll send across the deck to the branch and happy to take any questions you might have now. Thank you all for your patient listening and sincere thanks to the branch. I personally would have loved to be there at the branch, spend this time and then play table tennis before I leave for the Chennai. Over to you, Chairman.